Hey everyone, welcome to this session. My name is Benjamin. I will be your host here. So we will be both on YouTube for the streaming and also on the XM Live Education platform where you can join me and ask any question if you have. The topic of the day is Bitcoin cycles and liquidity dynamics. We will try to understand what drives the Bitcoin price action over time, the various narratives that came for Bitcoin, because Bitcoin really had several narratives one after the other, and try to look at the data in order to assess what's really driving Bitcoin price action. So first, we'll talk about Bitcoin and try to understand what makes Bitcoin unique, okay? Because really, Bitcoin is not like the other assets in traditional finance. It's really a hybrid asset because a lot of people see it either as a risk asset, okay? So tech asset, very risky, or some others see it as a store of value, okay, which would have like kind of the same properties as gold in time of need, or just a leveraged liquidity asset, meaning that Bitcoin is a sort of sponge of central banks' policies, meaning that when you do have like easing condition from central banks all over the world, it would benefit Bitcoins. When we do have like tightening condition, Bitcoin would suffer and have like a downtrend, and of course is very reactive, so would have this downtrend before traditional finance. So let's look at the various narratives for now, okay? So you can understand each one of the narrative that form on Bitcoin really. So the store of value narrative, which is kind of the prominent narrative in, let's say, the past 5 years. Bitcoin has been seen as a digital gold and basically a hedge against currency debasement. So it could be a hedge against inflation fears, okay? And we had a lot of inflation, especially following the COVID era, really. We can probably expect another inflation wave due to the war in Iran currently, with the massive increase in oil. So for now, of course, CPI, we just have the number on CPI for US. Today, it's flat, okay, so it's as expected. But to be honest, like the next inflation data will probably be skewed to the upside due to like the price of oil, which skyrocketed. In those kind of condition, people are fleeing into store of value asset, hard assets, in order to keep to not be debased really. And gold is the most known and used store of value, of course, but Bitcoin would have like these same properties on like for digital native people. Then, of course, there are traders and people who see Bitcoin and crypto, of course, as a risk asset, only a risk asset, meaning that it moves with tech stock, okay, and broader market. So there is a high correlation between Bitcoin and Nasdaq, and also between Bitcoin and software, okay, very high correlation. And people who trade Bitcoin would basically trade a sort of leverage Nasdaq. Okay, and then it would mean that, of course, it performed very well when liquidity is abundant, okay, and risk appetite is very high, similar to tech stocks, similar to Nasdaq, and that basically Bitcoin would trade like a leverage version of Nasdaq. So we do have a slide later on during the presentation. We do have a slide talking about the correlation with Bitcoin and Nasdaq, and also the skew, meaning that for the past months, Bitcoin has still been correlated to Nasdaq, even if it's been skewed negatively, meaning that Bitcoin is way weaker than Nasdaq. Bitcoin can also be seen as a liquidity proxy sometime, okay? The idea is that Bitcoin is a reflection of the flow of global money. So it's sort of a sponge which absorbs the flows, okay? And basically, Bitcoin can expand when central banks have a easing condition, okay? Easing monetary policy all over the world, of course, mainly US, mainly Europe, of course, but all over the world, really. And when there is tightening cycles, this is where Bitcoin corrects, and usually before other assets, really. So let's talk about the concept of market cycles. The idea here is that a market cycle in every asset class, okay, we'll be more specific about Bitcoin after, but first about all the assets. The market cycle is the tendency of financial markets to move through recurring phases, okay? Those phases come and go and come and go again. And usually they are driven by collective investor psychology, okay? It's like mass crowd behavior and usually crowd behavior act kind of the same when they are in similar conditions. Of course, macroeconomic factors, as I said, you do have like easing cycle, then tightening cycles, then easing cycles, which make sort of waves which are cycles, so come and go. And of course, you do have asset-specific fundamentals. In the case of Bitcoin, it would be the halving, and we will talk about it in the next slide. So the four phases of a market cycle, okay, we'll start with that. We start with the accumulation, okay? For the people who are aware of Wyckoff, this is a very good base to understand how accumulation works. The idea is in accumulation, the smart money enters, okay? It enters because the price is low or kind of bottoming, okay? And the sentiment is very, very negative or apathetic because it's coming after a huge downtrend usually, okay? Huge bear market, huge downtrend. And this is where the accumulation is coming in. The people who are buying, like the smart money, are basically informed investors and long-term believers into the asset. And basically, they see the disconnection between current prices and where they feel that the price should be in a few months or years. Okay. Usually in this area, the market emotion or capitulation and despair because most of the tourists and the people who don't really care about the asset have left already. Then after that, you do have the markup, okay, which is basically the bull market. You start to have higher highs and higher lows on higher time frame, okay, like a traditional bull market. You have a sustained upward trend, okay. The confidence, of course, is growing. More and more investors are talking about it. There is talk about this asset class or this asset in a lot of media, from institution, from friends, from social media. Okay, they are all entering the market and talking about it on the news, on the television, everywhere, really. This is usually where you have FOMO, fear of missing out, okay? Because you basically hear everywhere that this asset is the next new thing. So a good example is basically metals, gold and silver were like that like a few months ago. Like the market was really interested in metal at the time. And on the media, everyone talked about gold. Why is it going up? Why all the people buying in, etc., etc. So usually this is the main part of the bull market, okay? And it starts with hope and optimism, basically early on, and basically move into belief and thrill at the end of the bull market. Of course, like every bull market, there is a time for distribution. Okay, distribution here, here, and here is basically where the smart money start to exit. Okay, and the price peak either in a sideways range, like in 2021 here, for example, or in a volatile range, like the first two bubbles back in 2014, like 2013 and 2017, really. So there are various ways of distributing, but the end result is the same. Okay, this happens when the sentiment is very, very bullish, usually even euphoric. Okay, and the people who are selling are the only investors which basically who basically bought during the accumulation. So they made multiples of the investment and they are finally distributing into euphoria. Of course, you do have euphoria and also denial. And denial is the first clue that the cycle is ending and we are distributing and basically coming down after. You start to have some clues that the market is reversing, but a lot of people they dismiss those kind of clues. They are in denial and they don't want to believe that finally you do have like a lower high, which is the first clue that the market is reversing. And of course, after that, you do have the markdown, which is basically the bear market. So basically lower highs, lower lows, lower highs, lower lows into the capitulation. Okay, so this is the opposite of the markup and the bull market. Okay, basically it's a sustained downtrend which is happening, lower highs, lower lows, and the sentiment usually shifts from denial directly to fear and panic. Okay, because people finally realize that the parabolic move, or at least the bull market, is finished, and now we do have like a correction. This usually lead to another cycle because at the end of the downtrend is where the accumulation is finally coming in again. So in the case of Bitcoin, there are few things which are interesting. Okay, if we look at the timing for the cycle on Bitcoin, we can see that this top to this top, we did have 1,460 days, okay? And this top in 2017 to this top in 2021, we also had 1,430 days, okay? Very similar. If we add 1,430 days from this top here in 2021, it would give us mid-October 2025, okay? 1,430 days, mid-October 2025, which basically was the last cycle for now, cycle top for now, okay? So mid-October 2025 was basically the all-time high at 126K for Bitcoin, okay? So we really have very, very similar timing between the previous macro tops for Bitcoin. What's interesting is it's also happening for macro bottom. Okay, so this macro bottom to this one, you have 1,430 days. This bottom here in 2018 to this one in 2022, you also have 1,430 days between the bottoms, the macro bottoms. If we do add 1,430 days to the previous bottom, the one in 2022, this would basically give us a next bottom around October 2026. Okay, so it doesn't necessarily mean that the absolute low will be similar mid-October, early October 2026, but it maybe give us a sort of overview of how long could it be if the cycle continues, of course. So for Bitcoin, there are maybe several reasons for those bubbles and those 4-year cycle and why did it happen in the beginning and why it's continuing to happen. So basically in Bitcoin, there is a mechanism called halving, okay? The halving basically cut the block reward in half every 4 years. So basically you do have miners and the miners are the people who ensure that the network, like the blockchain, is working well, okay? They look at the transaction, they validate the transaction, they maintain the network. In exchange for that, okay, they receive some Bitcoin, okay? It's coded within the code of Bitcoin. They receive like a reward. But this reward, okay, is divided by 2 every 4 years. Meaning that for the people who do a bit of logarithmic charts, if you basically assume that here it's time, and here is the number of BTC in circulation. For the people who assume that the demand is the same, you cut the supply hitting the market by 2